Hey guys, what's happening? Welcome back to the program. It's good to be back. So last week, a little bit last minute, there was a relative of mine who needed some help on their taxes, and so it was either Monday night or never. And so I had to ditch out on the live stream to just do what I had to do. So apologize for that. Sorry for the last minute notice, but it was something that needed to be done, and that's just the way I roll. So, hey, it's good to see everybody tonight. I thought I would share a little bit of a story about the bees and honey. So the flow has begun in northern Alabama. We have blackberries blooming. I think I saw somebody posted that privet is blooming. So what that means is the bees are getting a lot of nectar and a lot of pollen, and they are just having a ball. So I'm going to get in the hives again tomorrow. I was in there last week. I'll get in there tomorrow just to make sure they've got ample space and that they're not, in need of anything. So that's pretty cool. But, I think I mentioned to you guys a few months ago, back in October, I started a business. It's not a passive income like it is with dividends, but it's a honey business, and it has really taken off. So I will be delivering honey tomorrow. The month of April will be my largest sales month ever of the last 6 months for honey. So things are going well, man. And of course, it's taken a lot of time. It's taken a lot of effort. But boy, am I learning a lot about just, honey and quality and, just the process of getting that stuff bottled and shipped and, building relationships with stores. And it's been a blast, actually. I'm really, really enjoying that. So anyway, with that, today I wanted to talk about my portfolio. How's it holding up? Where are my thoughts? What are my emotions around all that's going on with the tariffs and the uncertainties? And, I was watching just a little bit of CNBC today, and they are just basically about to melt down, which I find to be completely hilarious. So I do enjoy it really more for the entertainment value than anything else. So with that, though, let's go ahead and see who all's in the show tonight. All right, we got Pat here. Another big hit today. Yeah, thank God for dividends. You got that right, Pat. That's a good thing about dividends, is that they are steady, especially if we pick quality companies that are continually growing their dividends. We can count on that. If that is, Pat and I are in a stage of life where dividends are really important. And so with that, we can, take solace and comfort in the steady dividend payments. So it's good to see you, my friend. Things are probably warming up a little bit for you way up north in Minnesota. So Brad, hey, Kevin and friends. That's right, man. It's good to see you, buddy. Billy Johnson is here. He couldn't sleep this one out, so I appreciate that, man. It's probably like really early in the morning there for you. So glad you joined us, Billy. It's good to see you, man. Michael Swami's here. It's always a party when Michael is here. Let's see. Billy wants to know if I can deliver some honey to him. You're going to have to come stateside. If you come stateside, let me know, and we can probably work out a deal. So, all right, Jim Betts, GE all. So General Electric all. No, I'm just kidding. That's good evening. And then we got Oscar on the show tonight. So good to see you, Oscar. So let's go ahead and kind of get this thing kicked off. I'm also going to want to know, what stocks are you buying? Are you buying anything, first of all? So, if you can let me know, are you waiting? Are you buying? And if you are buying, what is it that is on top of your list? So you'll see mine here, and then I'd like to see what you guys have on your list as well. So to get this kind of cranked up, Let's do this. Okay, fantastic. I'm going to try to make this just a skosh bigger. There we go. Does that help? Let me get rid of this. That didn't help. Okay. All right. So this is going to be year-to-date performance of my portfolio and key holdings. So what I thought I'd do today is give you a little bit of an update on where the portfolio has been over the last 4 weeks. It has been quite the roller coaster. But then I also compare the portfolio to the indices like the Dow Jones, the S&P, the NASDAQ, and something else. The Russell 2000. So just to kind of see where the portfolio is performing. And so I'll share all that with you. And then I thought we would go into the portfolio itself, let you look at my biggest holdings, where they are, and then just kind of talk about my feelings on all that. Hopefully that's worthwhile. So let's go ahead and get started. You can see one thing I wanted to share. I think I shared this a couple of weeks ago, but it's important to kind of go back through it again. You can see since around 1950, you can see I think this is the S&P 500, how it has performed. You can see a bunch of ups and downs, but overall you see an upward trend. Now, I will concede the point that if you can catch things at the bottom of one of these valleys, that's better than catching it at the top of a peak, right? But it's also important to understand that historically the market has gone up in the long run. So I'm a long-term investor. This is why I'm a long-term investor, is because I don't have to catch all the peaks and all the valleys. Matter of fact, I don't think I can. I'm not capable of finding the bottom of the market. So let's take tariffs, for instance. Let's take tariffs. So tariffs, all the president has to do tomorrow is say, hey, you know what? We're going to move back to doing something different, doing what we used to do. And then all of a sudden the market will come back like crazy, right? So, I'm not sitting here thinking that the bottom's in or the bottom's not in. I don't really know. I don't know whether it's the bottom or not, but I do know that I don't want to try to time it because I never can do that. So anyway, so there's that. All right, so let's take a look. Wealth Circuit portfolio performance year to date. I started tracking this back at the end of March, and I shared that with you on a live stream. And now each week I've been adding to it. So it's really kind of interesting to see how this thing moves. Take a look at this. Back at the end of March, our year-to-date performance, we were down 0.5%, which, compared to all of these indices was doing, really, really well. Now, here we are, April the 18th. So from on March 31st, we were down 0.5%. On April 4th, we were down 8.3%. I mean, that was a huge move. But again, still outperforming all of the indices. Then on 4/11, we were back down only 3.77%. And then at the end of Friday, we were down 5.63%. Still doing well compared to the indices down here. We're doing 4.2 percentage points better than the S&P 500, 10% almost better than the NASDAQ, 10% better than the Russell, and around at 2% better than the Dow Jones Industrial Average. So, things are, I'm not loving being down 5.6%, but I'm loving it better than being down 9.8 or 15.5, if that makes sense. So, but again, I've invested in quality companies. I know that there is market risk, there's company risk, and then there's market risk. And maybe I can give you an example of that. This past week, we saw a company risk in United Health Group. So it was one of my larger holdings. And because of the tremendous amount of decline that saw in this past week, and remember, that's baked into this 5.63% year to date, right? So it's down, 30%, I think, overall, maybe more than that over the last week. United Health Group is. So, that's a company risk. They came forward and they said, hey, our forecast is going to be lower, and we're going to see these headwinds in our earnings. And the market is punishing that one company. It's also transcended into that whole sector. Like Elevance Health is also taking a bit of a beating. But it's that's a company risk, and so one of the ways we manage that risk is by diversification, by getting a portfolio of at least 10 to 15 stocks, individual stocks, helps to manage the risk of the individual company's crap in the bed, right? However, it is impossible to get rid of market risk. And so market risk is what we're seeing now, where we got tariffs and we got things that are really driving the entire market lower. It's impossible to hedge. Well, I don't know. It's not impossible to hedge it. It's impossible to do risk management around market risk unless you just really pull out of the market, or unless you're going to buy some puts and calls and things like that. But at the end of the day, you typically don't do that for your entire portfolio, because you end up paying premiums that offset most of your gains that you get. So it's not really worthwhile to hedge your portfolio that way. At least it's not for me. Maybe you guys have figured out a better solution for that. I don't even know where I was going with that. But anyway, the point is, long term, the market goes up. We are in a down cycle right now. It could come back anytime. It could go further down also. So we're at a place where we need to make some decisions. Are we going to stay in the market? Are we going to keep adding? What is it that we're going to do? So let's take a look real quick at the portfolio. You can see here, I have made this a little bit bigger so you can see it. I'm going to sort this. First of all, I'm going to just go with the ones that I own, and I'm going to sort it as a percentage of the portfolio, go largest to smallest. So you see that 29.7% of the portfolio is in VU, which is the S&P 500 ETF. So, there's a part of my portfolio that I'm not going to need for some time, a long time, if I need it at all. And so there's a reason, even though I'm retired, that I continue to have that exposed to the S&P 500, which is, it's long-term money to me. So, maybe it's for my kids or, whoever, but somebody will reap the benefits of me having that in VU for this point in time. So that's an ETF. Now let's take a look at my largest holding, which is Microsoft. And we'll go into the portfolio performance here in a second. But Microsoft is 5.2%. It is my largest individual holding. Google is the second largest individual holding at 5.16%. Amphenol has worked its way into the third slot, and mainly because United Health Group declined so much. UNH was number 3, and then it basically crapped the bed, and so we ended up with Amphenol taking it over. And I didn't even do anything. I didn't buy any Amphenol. I didn't sell any UNH. It just kind of happened because UNH went down so much. Now, here's a kind of an interesting one. The number 5 position in my portfolio is Hess Midstream, which is a lot of people think it's an limited partnership, and it is not a master limited partnership. It's not. It issues a 1099. It's got a great dividend yield, and it's not a bad price right now. If I currently own 3.8% of it, so I'm not really in the market to buy more. But if I were just getting in, now would not be a bad time to do that if I were at a 0% holding on that. Atmos Energy is another one that has done very well. It's about 3.4%. Hershey is about 2.9% of the portfolio. And Parker Hannifin is 2.9. Elevance Health is 2.9, roughly. Johnson & Johnson down at 2.75. And you can see the diversification here, right? I've got basically three stocks. Let's just say three stocks that are 4% of the portfolio or higher. I've got a couple that are in that 3.8% range. But then the rest of them are all down around 2.5%. And my lowest one is T. Rowe Price at 1.17%. I have a total of 24 holdings in the portfolio. So, it's important to be diversified, but remember, diversification does not eliminate all of the risks. So, all right, let's see. Before I go further, I will hit some of your questions here. I'm kind of just chatting and and not paying attention to what you guys are doing. So let's see. So Billy's adding FDX. Is that FedEx? FedEx and Archer Daniels, Midland. So those are good ads. Michael Swami says, no change in what I'm doing, mostly SCHD, a little TPL. TPL. Remind me what TPL is. It's on the tip of my tongue, but I've got to look it up. Oh, that's not who I was thinking it was. Texas Pacific Land. So that's interesting. Yeah, we may have to look at that at some point. Okay, so little TPL. Jim is he bought 2 ETs, 3 CVXs, 2 Amazons today, not backing the truck up on anything, just nibbling away. Yeah, I think that's a great way to do it, Jim. Just a little nibble here and there. I haven't bought anything in the last week or so, couple of weeks maybe. Just kind of letting things, as my grandmother used to say, just let the hind end drag, I have no idea what that means, but it always kind of fits situations like this. So if you have nothing else to say, just say, hey, I'm just going to let the hind end drag. So Billy's adding Lockheed and Chevron. Brad bought 100 shares of SPLG today. Man, that's a great ad. Pat's got SCHD and Realty Income. Other than just saving cash for a purchase this fall, glad I did most of the savings before everything went crazy. Yeah, no, that's a great point. I was able to, there's times when I need to pull out money to buy certain things, pay my tax bill, stuff like that. And so that has actually worked out pretty well for me. So Fast Eddie, yeah, the bees are doing great, man. Believe it or not, I have 7 hives now. It's crazy to think about. I caught a swarm the other day. I should have uploaded some of those videos, but maybe I'll do that for next time. But yeah, the bees are doing great. They are moving in and out of those hives, and they're doing what bees do. I put honey supers on already, so I'm anxious to get in there tomorrow and see how they're doing. See how those honey supers are filling up, if they are. Hopefully they are. So Jim says that Lockheed has a new CEO. I did not know that. That's interesting. Wonder why. Yeah, good deal. Jim was up 0.46 after today. Maybe he's below 0. Yeah, today was a rough day. And again, my numbers were as of Friday. So I think, let me take a look here really quick. Yeah, I was down 2.12% today. And what did the market do? You guys can tell I am in the honey sales mode at this point. I got a lot of deliveries tomorrow. Yeah, about 2.36. The S&P went down 2.36. The Dow was down 2.48, and the Nasdaq was down 2.46. So pretty steady across the board. That's wild. All right, so let's see. Oh, El Dynamico. Good to see you, Antonio. Man, it's great to have you here this evening, my friend. So, Wallet Invest bought some VTI. That's great. Loving these prices, absolutely. Mr. Income has joined us. We are in the presence of royalty tonight. Good to see you, my friend. So yeah, I own a lot of healthcare. Let me see how much healthcare I own. See if it's on here. Yeah, it's what is that? Oops, shouldn't have done that. About 9.5% of the portfolio is healthcare, so I don't think that's too bad. It's not like 20% or 25. It's less than 10%. So I don't. I'm not too alarmed by that. I think my two main ones are UNH and Elevance Health. Those are the two. So all right, let's see. Let me get back over here where I can see you guys. So El Dynamico says he's adding RCC so he can bring his average cost down. Yeah, no, I mean that's not a bad idea, right? So if folks are dollar cost averaging, these are fantastic times for you because if you're dollar cost averaging in, you probably don't need these investments right away. So you're buying at low prices. If you're going to be 10, 15, 20 years down the road needing these investments, these are great times for you. So keep investing is my recommendation. Okay, it's ARCC. That's good. Yeah, ARC is a good one. So Jim just posted on Discord is being down 1.16 today. Definitely below zero. Not as much as the other indexes. So I'll take it. Absolutely. That's the way we got to look at it, man. Sometimes, when you're in the boat and the water goes down, you're going to go down with the water. And so, we just want to be, at least the way I like to do my portfolio, Jim, and you're probably in this boat as well, is I like to do mine where I am exposed to the upside, but not so much so that I risk losing as much on the downside. Does that make sense? So I'm willing to give up a little exposure, a lot of exposure actually, on the top side. So if the market goes up 25%, I might go up 15 or 18% to kind of trade that on the downside. So instead of being down 10% like the market is right now, I'm only down 5 point whatever that was, 5.6 or 5.3 or whatever. So I'm willing to give up some top end gain to give back some low end losses. So, hey, my buddy Ryan Williams is here. Good to see you, man. I hope you and your family had a great Easter. Yeah, I hope you did too. And glad to hear your honey empire is on the rise. Yeah, it is. It's really wild. I'm really enjoying because first of all, I love to learn stuff. You guys know that, and it's just been really fun learning all of that process around how all that works, and building relationships with customers. I've been an accountant all my life, right? So financial people, we don't have to work with customers. We work with numbers, and so anyway, I've got these customers, and I need to keep them happy and build relationships with them, and so it's just really been fun. So thanks for sharing that, man. Hope you guys had a great Easter as well. I got to get out to Vegas sometime just to come see you, man. It'd be fun. We can have a piece of pizza or something together. Rust Moments just woke up, but he's here. Man, you must be doing so many live streams, man, that kind of wore you out. So glad you're here. Here's El Dynamico. He's got a good question. If Microsoft is at its 52-week low, are you buying more shares? Or are you sticking with the 5% of your portfolio in Microsoft? Yeah, right now I'm staying with my 5%. And my rule, and everybody's got to have their own rules, but my rule for my portfolio is that I want a top end to be around 5%. So if I've got a stock at 5%, it means that I really, am buying into the thesis of that stock. So now I can, according to my rules, I can go up to 10%. So if something were to happen and I saw, some, gain that's really going to happen and that is really undervalued, I would I would take advantage of that opportunity, even, take it to 6, 7, 8%. But typically 5% is where I like to cap the investments off at. So I've got two at that 5% range, which is Microsoft and Google. I know that's it's not like I'm taking a big risk there. Those are solid companies. Google's struggling right now because of the lawsuits and things like that. And there may be something to that, but eventually I think they're going to work through that. It might take a while though. So anyway, I think Microsoft is in a good spot. But I don't think I would add Microsoft here. Yeah, I don't think I would add Microsoft here. I would add some other things. I think Google is a better buy actually than Microsoft. So there may be some others, but I do have it as a buy in my portfolio. I do have, well, both. I have both Microsoft and Google as buys. So if I, if something happened, if some news came out about Microsoft and they had just launched some new AI something or other, it might be a catalyst, right, for me to buy some more. But they haven't done that I know of at this point. Let's see. I have no doubt you're able to build that and trust factor with your customers quite easily. And yes, would love to see you out here in Vegas. Coffee's on me. All right, that sounds good. So I'll buy the steak, you buy the coffee. How's that sound? I went to Vegas. When was it? Oh gosh, it's been several years ago, long before you moved out there. And my wife went out with me. Actually, I flew out and then she flew out to meet me. It was a few hours later that she got there, and her flight had been delayed. And so she got there, and it was like, oh, she was really hungry, and because she had been on a plane for hours. And so anyway, we went to this restaurant and we got like a burger and soup or something like that. And for two people, it was like $90. I was like, dude, I am no longer in Alabama. Anyway, let's see. My portfolio would be pretty flat with 22% of the portfolio being in preferred shares. Yeah, that's probably right. You got a lot of gain on the income side rather than on the capital appreciation side. So, but it makes sense with where you are. So 5% is what my original goal was. 5%. Of holding any original holding. 5% of any holding in your portfolio, right? So realty income is now at 8.53%. I think I need an intervention. I can't stop adding. Sometimes you just got to do what you got to do, man. And if you need an intervention, let me know. Maybe we can do that on a live stream sometime. We can have some people here just to talk you off the edge, man. That'd be great. Snap-on is looking interesting. Let's see. Do I have that in my spreadsheet? Let me just check it real quick. I think I do, actually. Let me check. No, I don't. I don't have it on there. Let's take a look. If you guys don't mind, we will take a look. And I'm going to have to give me a second here. I've got to move that to a new window, pull that over here. And I forgot to pull up all my fun little apps. All right, let me share this with you now. All right, let's take a look at Snap-on. Oh, we got a note published on UNH. I have not seen that yet. We'll look at that here in a second, but we're going to look for my buddy Ryan Snap on. Man, look at that safety score, 99, A minus credit rating. Pretty solid company. They were down 4.3% today. Let's take a look at some of the financial numbers. Oh, their dividend growth is crazy, man. 14.5%. Last one was in November of 24, so not expecting anything for a little while. 15-year growth streak, so that's going well. Let's take a look at some of the financial numbers. Payout ratio looks pretty decent. The thing I would caution here is if you see the payout ratio going up, then that means that they're growing their dividends faster than their income. So what I like to see is a company that's growing its dividends and its payout ratio is flat. That means that we are sharing in the growth of the business, not the deterioration of the business, if that makes sense. Let me know if that doesn't make sense. And not that this is bad. I mean, 45% is not bad at all. And of course, going into this market that we're in, it might just be the way it looks, but I see it climbing 22, 23, 24, and then next 12 months it's going to be even higher. So that's a little bit of a, I wouldn't even call it a red flag. It's more like a caution flag, maybe. Yeah, the earnings are kind of flat, but that kind of makes sense with what everybody believes the market's going to do. Yeah, return on invested capital, 16%. That's pretty solid. Net debt to capital is 0, and interest coverage is 27.5. So pretty solid company all the way around from a financial perspective. Let's see what Morningstar has them valued at. They have them at, a fair value of $236 and a price of $305. So according to Morningstar, they're trading at a 29% premium. That would need some attention, I think, to buy it at a 30% premium almost. This would be a good time to go into my fast graphs. Oops. Maybe not. Oh, well, I guess I better check on that. Can't get into fast graphs for some reason. What else can we look at? Let's look at tip ranks. SNA. Now, the analysts show about a 22% upside at 355. It says 292. Oh, I know what it is. This is always a day delay. So that 305.44 on Snap-on was from yesterday, from Friday. So it went down $13 today. Wow, 4.3% down, $292. So it's still, overvalued according to Morningstar, but just never know. Analysts are saying it's got a price target of 355. So, I mean, it looks very attractive. I think I might want to wait for maybe a lower entry. But yeah, it looks pretty good. So Rust bought some United Health Group for the first time today, 2% yield. Risk to reward looks good here. Yeah, it does. I agree with that. Yeah, Ari would be glad about that. Billy says Ari is the CEO of UNH. I didn't realize that. That's pretty good. One thing I forgot to do is to actually go through the portfolio so you guys could see, like, for instance, Alphabet, Google, It's just been going down, right? So I'm down 8% on Google, and from investment perspective, the total return. Well, I'll say the total return, the capital gain or loss for my Google transaction is down 8.3%. This is not year to date; it is investment to date. Amphenol is down 5%. Now, Atmos Energy, it's just continues to go up, man. I'm up 57% on that. I've just been really pleased with that. It's 99% of its 52-week high. It's up 32% year to date. It's just done well. Carlisle up 5% on it. ConocoPhillips, I'm down 10.6. I'm not adding at this point. Even when I bought ConocoPhillips, I was concerned about the drill baby drill and whether that would drive oil prices down. I think it is. I think oil prices are going to continue to be pressured lower, and so I'm not really adding any oil and gas at this point. Just waiting on what might happen with some of that. So, but if I were to add oil and gas, it would be ConocoPhillips. I really like what's going on there. But I'm down 10.6 on that. Then I've got what did I? Oh, Elevance Health. I'm still up 4% on that, but it has taken a beating this past week after the UNH debacle. EOG Resources up 22% overall on that. General Dynamics up 38%. Hess Midstream still up 15.5% on that, even though it's down 2.85% today. So I think a price of $36.46 for Hess Midstream is it's a good buy. So if it continues to struggle, I might rethink how much I have invested in that, because it's got why do I say that, right? Oh, there we go. Why do I say that? So Hess Midstream, HESM. Now it's got a 40 safety rating, so some people are scared off by that. Double B plus, which is I think a junk grade credit rating. So that it's got some struggles just from the balance sheet perspective, but there's reasons for that, and I can get past that. It's got a yield of 7.69%. That's not too bad. And it has grown in value year after year. So you can see in my portfolio here that I am up 15%. So not only am I getting 8% per year in dividend yield, it has grown by 15% as well. So it's not a dividend yield trap at all. It is giving me both capital gains and dividend returns. It's been a really nice investment. Now, Hess Midstream was trading at the 42 level about a month ago. So it's down about 20%. So it used to be a little bit higher. So SOX, I'm down 6.28%. Johnson Johnson, I'm up 7.9%. Lockheed up 30%. Microsoft up 10%. Parker Hannifin used to be a double for me. It used to be up over 100%. Now it's up only 67%. RTX is up 49%. Now here we go. Stanley Black & Decker. I have successfully held on to this stock, and it has just continued to drop and drop and drop. And just at the point where I say it can't drop any further, it drops even more. So I'm down 43% on Stanley Black & Decker. It is 1.5% of the portfolio, so it's not like a big investment for me. But at this point, I just don't see any reason to sell it. I mean, I'm just going to leave it there and just see what happens with it. 384.111 shares. We'll just kind of leave them go and see what happens. We'll just have to see. T Rowe down 3.7% on it. I just bought that, I think, a month or so ago, not very long ago. Hershey down 9%. U.S. Bank up 7. United Health, even after this 30% decline, I'm only down 8.5%. So there's something to be said about buying a stock at the right time. VU, I'm up 19%, and Verizon up 10%, Visa up 20%, and WEC up almost 30%. So, I can't complain overall with where the portfolio is. So now, we're taking a beating. Like today, we were down 2.1%, but, I'm still getting my dividends. I'm getting dividends every month, and so life is good. Get back to you guys. I'll stop talking so much. Okay, so Jim's thinking that SNA Snap-on is a buying opportunity since it's down 4.7% today. Fantastic. Let's see here. You're gonna say, Jim, considering adding more to it pre-producing soon. Yeah, I don't think you can. I don't. It's not a bad deal by any means. Keep an eye on payout ratio for sure. Still plenty of room there. But the trend could be concerning if it continues. Yeah, and as well as I do, that trends are our friend, and so sometimes when this happens, it just means that the economy has slowed down. But from a management team perspective, they're continuing to raise the dividend at a large pace. And I question the management team for doing that, because if they're seeing the business slow down, which is happening, we know that, why aren't they slowing the dividend down as well and preserving that capital for the company? And there may be reasons for that. They may believe it is a very short-term thing. And so, I would need to dig into that. But it's a question that I would ask myself. Google earnings should be fun this week. The earnings call will be the most important. Yeah, I think that's right. It should be quite an interesting week for Google. Actually, this whole quarter is going to be interesting for every company. Michael, isn't triple B minus investment grade? I think triple B minus is investment grade. Triple B minus and higher, and then double B plus and lower would be junk status. So they're one notch below investment grade, if my memory is right. If you would buy out all SWK stock, you would see their stock rebound. Yeah, that's a great point, Billy. If I bought them all up, then the stock price would go way up, and then I'd be buying at really high prices. So I don't think I'm going to do that. I'm just going to keep what I have and just see what happens. I mean, it's a long-term game. It's not it's not like it's 5% of the portfolio. It's 1.5%. So, I'm not too bad with that. No, it was double B plus, not triple B plus. So, yeah, Hess Midstream's credit rating was double B plus, so they are in junk status. But the main reason, well, I'm not going to go into that. You can look at it on your own. If you like it, buy it. If you don't, it's okay with me. I just like the return that I've been getting on that. It fits great for folks like me. So no, it's all good, man. No worries. So there's something else I wanted to look at. Did we finish over here? Yeah, we did. So we finished over here. We got the stock listing. Let's take a look real quick at the buys. Oops. Add the stage. Let's take a look at the buys. I'm going to get rid of the holds. Okay. I got to add the watch list as well. All right, here we go. Here are the buys for this week, and they're really not any different than the they're really not any different than what was there last week. So I've got, Microsoft is a buy, Google's a buy, Amphenol's a buy, Hess Midstream's always a buy for me. And well, not when it was 42, but it certainly is now. Caterpillar, I think it's at a good buy price right now. I have not added any Caterpillar. I'm just being really kind of slow to add anything at this point. Now, I may regret that at some point because, like I say, all it takes is one press conference to change this whole landscape. And I'm sitting here with, $88,000 waiting to be invested somewhere. So these are the stocks that I would pick. If I were to invest that 88,000, it would most likely be in these 8 stocks here. In some fashion. U.S. Bancorp, I think it's back in buy territory again. ConocoPhillips is in buy territory, and Carlyle, I think, is still in buy territory. So those are my 8 picks for this week. And here's another thing we can look at. Here's my stock pick report card. And actually, I don't think this. This is no longer in there. This is no longer there. Anyway, I've got some yellows here that don't need to be there, but that's not the point. The point is, based on the point that I recommended these stocks, so you can see November 4th, this was after I built this model. I went in and did, 7 or 8 picks at that point. And so you can see what week I actually added this to my pick list. And so I measure from that point forward to see how well it's done from the time that I first recommended it compared to the S&P 500. So you see here that ConocoPhillips is not doing well. It is 9.8% worse than the S&P 500 since the point that I recommended it. But it's because, oil and gas has just been a struggle. You can see that one of the other red items for me is Chevron. So you got Chevron and ConocoPhillips. Both of those are taking a beating because they're both in that oil and gas space. But you can see I got some that are doing well against the S&P 500. Northrop Grumman, and I don't own it, but I picked it. I didn't buy it. I didn't take my own advice, but it's up 21% compared to the S&P 500. You got Hess Midstream is up 15% compared to the S&P 500. Realty Income is up 15% compared to the S&P 500. So there's some good picks in here. There's some yellows, which are kind of trading pretty much in line with the S&P 500. So the greens have surpassed the S&P 500. The yellows are trading kind of in line with the S&P 500. The reds are trailing the S&P 500 by at least 2.5%. So I think overall we're doing pretty well. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 greens, and 2, 3, 4 yellows, and 3 reds. So 10 greens, 4 yellows, 3 reds. Hey, that's not so bad. I'll take that. Okay, now back to you guys. QQQ futures are up 7.6. Yeah, I noticed that even S&P, everything is up in the futures for tomorrow. Why does the stock price go down after you make a purchase? I don't know. It just kind of works out that way sometimes, doesn't it? I don't know. I'm just at a point where I if I find a price that I like and it's a stock that I want to add to the portfolio, I just close my eyes, pinch my nose and dive in. So that's kind of what I do. Yeah, being blind, I never noticed that until recently. Yeah, I mean, sometimes it just works out that way, Only 34% of Amphenol revenue comes from the USA. Is that a good thing in this tariff environment? I would say no. And I think that's why Amphenol is struggling in this environment, because anything that's coming from overseas has the potential of being tariffed, which means that And Stanley Black and Decker is fighting this as well. Most of Stanley's stuff comes from China and Mexico. So they either pay the tariff, which would cause their cost of goods sold to be higher, which means they need to raise their prices, or they bring it onshore, bring it into the U.S. and manufacture it, which means that it may be higher price as well. So I think Amphenol may struggle a bit in this tariff environment, just like Stanley Black and Decker. But I still like the company. I like the diversity of its product lines. It's a very similar product to me as Parker Hannifin. Not a very similar product, very similar business model to that of Parker Hannifin. So I like that business model. Yeah, Russ is late, but he's happy to catch the end. That's usually the best time, Russ. It means that I'm about to get off of here. So very close to starting a snap-on position to answer Ryan's question. There's no telling how long ago it was. Yeah, no, it's certainly in a good position. The only challenge for me is that Morningstar has it at a fair value. It's probably running about 25%, even after today's drop, running at a 25% premium to its fair value. So it's something that you would want to, just make sure there's some companies. Hershey's a great example of this. So Hershey for years traded so far above its fair value that it was just very popular. They made great management decisions. That was a great company to own. And so you had to pay up. You had to pay a premium to get that stock. And today you can buy it below fair value, I think. So if not, it's right at fair value. So at some point, that my belief is at some point the intrinsic value and the stock price will cross, and it doesn't mean that they will run together, but I think that they do cross at certain points. So I think I'm gonna wait at this point, but we'll see. I've been wrong before, so, and I'll be wrong again. So it'd be an exploratory 1 to 2 share position to get skin in the game, take it for a test drive. Yeah, that's not a bad idea. I've done that before. Yeah, tell me what you think about this. One of my rules is that if I'm going to buy into a stock, I used to do that all the time, Russ, and I ended up with 50-something holdings in the portfolio, and I was spending as much time on a, $1,000 holding as I did on a $30,000 holding in the portfolio. And I just got to the point where I was like, if I'm going to get to the point where I am buying into a company, I'm going to be so convicted about that company that I'm not going to invest any less than 1% of the portfolio in that company. So I don't know if you saw this earlier, but I have no stocks in my portfolio that are less than 1%. My lowest, let me look it up here. Get rid of that. Yeah, my lowest holding is T. Rowe Price at 1.17%, Carlisle's 1.21%, Stanley's 1.5%. So those are the that's as low as I will invest anymore. And it kind of keeps me from having so many stocks. Not that that's a bad idea or anything. I'm just saying it keeps me from having so many stocks in the portfolio that I can't really keep track of everything. So for me, it was a personal decision. I did enjoy adding stocks to the portfolio, but man, it was a lot of work. And so now I can sell honey and work my bees and still watch my stocks. So works out good. All right. I think I may need some context for this. If you're going to jump off the deep end, jump. I'm not sure what deep end that is. Anyway, Let me know, Fast Eddie. I'm usually I'm pretty good about tracking the conversations, but I think I missed something on that one. Yeah, it's a valid point. Have 14 individual stocks and being very selective. Yeah, absolutely, man. And I think that makes sense, and 14 is a great number. I mean, I'm looking for anywhere from 15 to 25, and I struggle because I like a lot of different stocks. And so I'm at 24, so I'm staying in that band, but I do gust up to 26, 27 before I actually pare back to get back below that 25. So, oh, I see what you mean. Yeah. By 1%, not one or two shares. Yeah. If you're going to, yeah, I get it. I get it now. Fast Eddie. Yeah. If I have conviction, I'm going to do at least 1% of the portfolio, which for me is, used to be a lot more than this, but 1%, let's see what the portfolio is trading at now. 1.43, so it'd be 14 grand. So I'd have to be willing to invest 14 grand in a company to and sometimes it stops me because it's like I don't want to invest that much money, so then I move on. It keeps me from having a lot of small positions in the portfolio. So anyway, but that's just me. That's just a personal thing for me. Let's see what Michael says here. My rule is that if I want to buy something, I have to eliminate something else from the portfolio. That's not a bad idea either. It makes me think really hard before making the change. And, that's not a bad approach because it makes you think that, what makes this new stock more valuable than something you already have in your portfolio. So, yeah, I think that's a pretty good approach, man. I like that a lot. So I think for now, let me kind of give you some thoughts for next week. Next week, I will be at the beach. So it is very likely, and it's going to be a family reunion, so it's going to be like 25 people there. So I am pretty sure I'm not going to be able to find the privacy to do the live stream in South Carolina. So we will most likely not have a live stream next week, but I may try to do an edited video while I'm there. I can find, a few minutes to do that. So maybe I can do that and I'll post it online. I don't know what the subject will be, but it should be pretty fun, whatever it is. So, all right. With that, guys, I'm going to get off of here. It's been great. It's been a fun time. I'm glad to be back. And I'm going to take next week off, but I'll be back the week after that. So you guys have a great week in the market, and I will see you on the next one.